everyone. This is All-Star Equity Investments Intro to Stock Trading course for beginners. Regardless if you're just starting your journey into the world of stocks or looking to solidify your foundational knowledge, you're in the right place. This course is designed to equip you with the essential skills and insight to navigate the complexities of stock trading confidently. Get ready to explore key concepts, practical strategies, and valuable tips that will empower you to make informed investment decisions. Let's embark on this exciting learning journey together. As you work through the modules, should you have any questions, please don't hesitate to reach out. This free course serves as a beginner's guide to mastering the market. So with that, let's go ahead and begin. So to start, I want to provide a high-level overview of what the stock market is and a clear definition of what stocks are. To explain this simply, the stock market refers to a collection of exchanges where activities related to buying and selling and issuing shares of publicly held companies take place. So essentially, investors can trade stocks, which are units of ownership of the company. Now, because of this, investors buy stocks with the expectation that their value will increase over time, allowing them to take profit through appreciation and also dividends. So with that being said, it's important to break down what stocks specifically are. Stocks are known as shares or equities, and again, this represents ownership within a company. When investors buy stocks, they become what's also known as shareholders because they have that portion of the company's assets and earnings. Now, the market provides a platform for companies to raise capital by issuing stocks as a means for investors to buy and sell. These are key concepts so that you can understand how the stock market works and functions, and of course, we'll dive into more detail. The most common purposes of investing are going to be 1. Wealth accumulation. Obviously, this will initiate generating returns on capital that typically exceeds inflation over time, allowing investors to secure their funds. 2nd would be achieving financial goals. So maybe you set a goal for your retirement, you're funding your educational needs, you're seeking to buy a home, or just simply becoming an entrepreneur by starting your own business. Additionally, future needs. We all know life happens, so you may need a safety net for future expenses or unforeseen circumstances. You may also want to take advantage of opportunities when investing. Capitalizing on market trends, economic growth, or emerging industries is a main motivating factor as well. That ties in with compounding wealth through reinvesting to see the power in leveraging time with accumulating investments. And lastly, a central purpose in investing is tied to diversification. Investing across various asset classes such as stocks, ETFs, bonds, and real estate help mitigate risks and have the potential to improve the overall balance of an investor's portfolio. Okay, so now let's discuss how stocks are traded. The first thing to note is that you will need a brokerage account, and I'll go into greater detail about how to choose the right broker, along with how to set up an account a little later in this course, so no worries on that. So investors need a brokerage in order to buy and sell assets. There are fees associated with the purchase of securities, but there is no fee to actually set up an account. Now you can purchase whole shares of a stock, or you can choose to buy contract options or futures. What's important to note about this is that orders are placed by either a market selection or limit selection. So for market orders, the important thing to keep in mind is that you can buy or sell a stock immediately at the current market price. But with limit orders, you can buy or sell only at a specific price limit or better. This then brings up the question of how do stock prices change? Let's jump into that as well. So now the question becomes, what are indexes? Indexes are benchmarks or measures that track the performance of a specific group of stocks in the market. And these indexes are used to provide an overall snapshot of the segment of the market. Now, with that being said, we have to look at composition. And this is going to be each index being composed of a specific set of stocks that meet a certain criteria. So this could be market cap, it could be the industry sector, it could be the geographical location, or other varying factors. In addition to that, we also want to keep in mind the purpose of indexes, and they serve as just indicators of the overall performance of a sector, and again, that could be the segment within the market. So let's go ahead and give a little bit more detail into this. Now, there are 3 main indexes. Of course, I want to go over each one so you guys can have a little bit of background knowledge. The first one is the Dow Jones. They track 30 of the large publicly owned companies here in the US. The second is the S&P 500. This is the most popular one. They represent 500 of the largest companies listed on the U.S. stock exchange. And then lastly is the NASDAQ Composite. They include more than 3,000 stocks listed on the NASDAQ exchange, and this is weighted by market cap. So within this, these indexes are going to be the ones that we spend a majority of time talking about within this course. Why? Because this is where stocks are heavily traded. So we're going to go ahead and take a look at this in a grander scope as we continue throughout the course. Now, before we get too deep within the course, I do want to offer insight that there are risks and rewards involved with trading. It kind of goes without saying, but I definitely want to mention it. Now, one of the things that you can have as a reward is the potential for high returns. Historically, stocks offer a greater ROI than other investment types over the long term. But on the other side of the spectrum, stocks are subject to market volatility, and this can experience price fluctuations. So individual companies can face operational risks, it can be industry-specific risks, and that can be from a micro or a macro level. So just keep these things in mind as you continue to learn and grow within the stock market. With that in mind, that brings up the topic of time intervals. Now, with anyone's investing strategy or with your plan, it's good to know whether or not you're investing long-term, short-term, or combining both. With long-term, you're holding stocks for extended periods of time. This could be years to decades. The benefit in this is the potential growth from compounding your returns over and over and over again. Now, with short-term investing, you're buying and selling stocks over a shorter period, and the aim is to capitalize on short price movements. This could be like the liquidity within the market, it could be volatility, any type of inefficiencies, whatever you would see. Based on that, spreading your investment across different stocks based on time, industries, and asset classes can help you to reduce risks. Now, this also entails diversification, which is why people always talk about diversifying your portfolio. That is something I always make sure that I mention to beginners as well, because you want to have optimal levels of performance within it so that you are mitigating risks and therefore continuing to lock in your profits. But we'll continue to talk about this as we continue to move forward within the course. Now let's discuss the elements of stock terminology so that when you move through the course, none of the words or phrases are going to be confusing. The first will be fundamental analysis, and this essentially is a method of evaluating a security by examining the intrinsic factors, and this is going to be things such as the company's finances to determine its value and potential future growth. Underneath that, we have technical analysis. This is going to be everything involved with statistical trends, chart patterns, it could be the activity, the price movement, volume, all those things will be anticipating future price motion. Essentially, we have IPO. Now, you may have heard several companies within the past year that you've heard IPO. One that comes to mind is going to be Coinbase, right? So they had an initial public offering, and this is the process by which a private company becomes publicly traded by offering its shares to the public for the first time. So essentially, they call it an IPO. In addition to that, we want to look at market cap. That's going to entail the total market value of a company's outstanding shares, and this is calculated by multiplying the current stock price by the number of shares within the stock. So keep these things in mind as we continue to move forward. So let's discuss a few more elements of stock terminology, just so moving forward there isn't any confusion. First, you may hear the term blue chip stocks. These are stocks of well-established and financially sound companies with a reliable history of performance. They also pay out dividends to their investors. So when you think of blue chip stocks, just think of stocks that have withstanded the test of time. Next, you may hear often the term bull market or bear market. A bull market is categorized by rising stock prices, whereas a bear market is categorized by declining stock prices. Additionally, another phrase you may hear from time to time is the price to earnings ratio, known as the PE ratio. And this ratio distinguishes a company's current share price compared to its earnings per share, therefore indicating how much investors are willing to pay per dollar of earnings. And if you need to reference back to these terms, feel free to do so. But let's go ahead and move forward to the next phase. Okay, so now I want to briefly go ahead and touch on the differences between stocks versus ETFs, because this is an imperative part of trading. Some people have preferences when it comes to trading stocks versus ETFs. And again, as you continue to develop and grow as an investor, you'll decide what works best for you. So when we look at stocks, understand that they're going to be individualized. So the ownership is going to pretty much be for that specific share of that company. versus if you're trading ETFs and you're investing in ETFs, those are going to be holding for multiple assets. So it could be stocks, it could be bonds, commodities, and these are traded on exchanges just like stocks are. Now, when we look at risks, you also need to understand the direct exposure to the performance, and that's going to be for just one particular company if you're just trading stocks. However, on the other hand, it's going to be for a plethora of companies if it's an ETF. Why? Because there's a collection of them. Now, this does allow you to diversify because ETFs, just in its standard definition, allow for diversification. So that's a perfect thing if you're looking to hold assets within a collection. Now, when we look at the potential returns, you're going to, again, only be focused on the performance of one stock if you're only investing in those individual stocks. But on the other hand, if you're looking at the ETFs, you're having that risk spread across multiple assets. And this can either impact the poor performance, or it could be for, one single company could drag things down. It could be high performing. It just depends on how it performs, right? So then we look at management. This is going to be something that requires active monitoring because you're only specifically focusing on one stock at a time if it's individualized. However, for ETFs, you don't have to manage them as much. You still definitely want to look at the performance and how the stock is, generating income and the cash flow and all these different things that you would need to kind of understand the individual companies within an ETF. But because there is a collection of them, it doesn't mean that you have to be so honed in and focused on it. It's definitely something not to ignore. You don't want to ignore it at all. But again, it's just individualized versus a collection of stocks. And then when we look at the costs for ETFs, they generally have lower ratios compared to actively managed mutual funds. So that's another positive thing when we look at the ETFs versus stocks. Now, you can trade either or, again, totally subjective in your choice, but it's important to know the differences between the two and how they function. Now, specifically, if you're choosing between stocks and ETFs, I always like to focus on those three main things that I always mention, and that's going to be your investment goals, your risk tolerance, and then, of course, your time commitment. So when you're looking at your investment goals, you're going to look at what is going to be suitable for you. Are you going to research and monitor? Are you going to be willing to do those specific research on companies? Are you looking to look at your risk management strategies and how they're preferred over the other? And then, of course, diversification. It's going to be extremely important, especially when the market is volatile. You definitely want to make sure that you understand what you're looking at. Now, stocks can be more volatile than ETFs. Why? Because it's one individual company that you're kind of banking on performing well. ETFs allow you to have a little bit more room for error just because other stocks within that ETF can allow for, any kind of correction to be made. Now, within time commitment, you want to manage your portfolio for individual stocks, and this is going to require a bit more time because, again, the attention to detail must be extremely important, and the knowledge is going to be a little bit different. But with ETFs, it's a little bit more relaxed and a little bit more hands-off. Now, as mentioned, you can, of course, choose to trade one or the other. It's going to depend on your financial goals and then, of course, your strategy all in all. So many investors combine both. They achieve that diversification by investing in both stocks and ETFs. And this is going to be how they target specific growth opportunities. So it's important to know how you have options laid out for you and then just go with what makes the most sense for what you're trying to achieve in the long run. Short-term investing, as I've mentioned before, is going to be something that you have within the shorter time frame. Long-term investing is looking at years and years out, decades out even. So just do what works best for you. It'll change over time. So don't feel like you have to stay set to one specific plan. You can always change it and it'll evolve as you continue to grow as an investor. All right, so in addition to that, I definitely want to touch on in the money, out the money, and then at the money contracts because it's important to know when you hear these phrases as well, what exactly they mean. So when you look at buying in the money, which I always stress is important because you want to be a profitable trader. You never want to enter into a trade and automatically be counted out because you didn't purchase the contract that was going to be best suited for what you needed. So when you look at in the money contracts, these are going to be options with intrinsic value that would result in a profit if exercised immediately. If you look at out the money options, it's going to be without intrinsic value that would result in a loss if you exercise them immediately. So let me give you an example. Let's say, for example, you wanted to purchase an options contract and the stock price was maybe $2 to $3 within whatever you're looking for the strike price. That's going to tell you that you're buying pretty much close enough within the money to make it sure it's profitable. But if you were looking at a strike price that's maybe $10, $15, $20 away from what the actual share price is, that's going to be buying out the money. Meaning you're buying a contract that is unrealistic if the stock doesn't rise and have that volatility and the volume to back it. If it doesn't even get close to that, you're pretty much entering a pointless trade because the stock won't even rise to that amount in the beginning. Like it won't even do that without even trying to reach that amount because the volume doesn't back it. It may not be backed by momentum. There's so many different things that can go into why that wouldn't be a wise choice. So I always say buy within the money. Now, when you're looking at the money contracts, these are options where the strike price equals the current market price of the underlying stock or ETF. So that's basically saying you're buying exactly at the money. So if the stock price is going to be the same as that strike price, you're buying at the money. Okay, so these are just different concepts you may hear from time to time. Keep them in mind. Again, always look at buying within the money. I don't ever recommend buying out the money unless you're just an extremely profitable trader who knows exactly what you're doing and somehow you have a strategy that just is unheard of and it's just so, elaborate that it works for you, then do that. But if you're a new trader, stick to buying in the money or at the money because these are going to be the ways in which you can strategize to make the most profitable trades. And then, of course, you want to make sure the setup makes sense, of course, as well. So just keep these things in mind as well. Okay, so now the question becomes, what's a profitable investment strategy or what's a lucrative way to invest in order to strategize to make the most money? One thing I think is often overlooked is sector rotations. And what this strategy entails is pretty much deciding to invest in sectors based on economic cycles or sector-specific trends. So what does this mean? This is a fancy way of saying ride the wave for the most part. Like seriously, sometimes you just have to ride the wave. And I know it's kind of cliche and some people think it's kind of, something to avoid doing. But honestly, when you're moving in the trend of what the stock or ETF is performing and you invest at the prime time, it for the most part can be very profitable. Some people think it's kind of overrated to do that because it's trendy and it's like, you don't want to do that. But when it comes to investing, you kind of have to relinquish that thought because it's all about understanding how you can maximize what your investment strategy would be to get those profits and those gains in the direction that you want them to be in. So when we talk about suitability, it's going to be from a macro level. We always know that's important. You're going to analyze and, of course, understand the sector dynamics. So, for example, if we're looking at any specific stock or ETF and how it performs, let's say during a seasonal thing, like for example, we know the holidays are coming up. So how are these particular stocks or ETFs performing when it's a holiday season versus how do they perform in the summertime versus how they perform in the winter? Like you have to understand those key elements when it comes to investing because again, if you're day trading, those are always going to be factors that tie into whether or not a stock rises or falls. How is the market performing? Is this stock even trending right now? You know what I mean? Those different questions are things you should consider. So this is suitable for any type of investor who wants to aim to outperform those broader market indices simply because you're essentially going with the trend. And if you maximize that strategy to the full capacity, you can outperform the market. A lot of times I do it, so I know it works. So I wanted to mention this because it's one of the things that's kind of slept on, but it's important to never never forget that you need to have that sector rotation as a main means of, maximizing your profits because there's no better way sometimes. I mean, I know it's, again, cliche to ride the trend, but just kind of go with it because again, you want to be able to be a profitable trader. And this will take time to develop the insight into it. But again, take your time, learn the market, and just do your best to kind of move forward with the knowledge that you gain. All right, now although this is a beginner's course, I do want to provide some advanced level options trading strategies so at least you understand the terminology. So as you advance within your trading journey, you're able to pretty much spot some of these strategies and understand what they mean conceptually. So I want to start by explaining what a covered call is. And this simply involves owning the underlying asset, so that's going to be the stock or ETF, and selling a call option against it. and this usually generates income from the option premium while potentially limiting the upside gains. So it's important to know there's pros and cons to any of these strategies. Now, a protective put, on the other hand, this involves buying a put option to protect against a decline in the price of the underlying stock or ETF. Now, this strategy provides the downside protection while allowing for potential upside. So that's a good positive thing in the sense that it allows for that protection, but it also kind of opens you up to other risks as well. So when we look at a straddle, this involves buying both a call option and a put option with the same strike price. And of course, it also has the same expiration date. This strategy profits from significant price movements in either direction. So it can go up, it could go down, and you can still be profitable, but you have to be very strategic with the numbers you're using. Now, an iron condor, on the other hand, this involves selling a call spread and a put spread with the same expiration date, but they have different strike prices. So investors use this strategy, the profits from the low volatility and the stable price movement within a range. So it's going to be, again, those zones. Now, the last thing I want to mention, if you've never heard it before, it's going to be a butterfly spread. And this involves buying a call spread and a put spread with the same expiration date, but with different strike prices. And this strategy profits from minimal price movement around a specific strike price. So again, these are going to be different phrases and different ways of strategizing how you can pretty much jump into trades. But I want you guys to know these terms so that when you hear them, you're not like, oh, this is foreign to me. You're able to understand specifically what these mean. You can take a screenshot if you need to, reference back to this video, of course, if you also need to do that. But again, you won't be completely shocked when you hear these types of phrases used as you advance within your trading journey. So I hope these make sense. I will make future videos kind of diving into each one of these strategies specifically because I have used quite a few of them. They are profitable if you know exactly what you're doing, but again, it takes time to kind of learn them. So I'll break them down in a future video so that everyone has full context and understanding of them. Okay, so before we move on, I do want to discuss how to trade effectively because I feel like this just deserves a little bit of consideration. So the first two things I want to mention are monitoring your trades and adapting because it's so important to frequently review your trades. This allows you to analyze the results to learn from your successes and your mistakes. With that in mind, you're also enabled to adjust your strategy based upon market conditions or economic factors, or even if it's just your own personal standard of your key metrics. Along with that, it's important to stay emotionally detached from your trades. Feelings such as fear and greed are ultimately a lot of traders' downfall because those emotions can lead to irrational trading decisions. And the worst thing to do is trade off feeling rather than logic. Never want to do that. And lastly, I must reiterate, losses are just a part of trading, y'all. I gotta say it a million times. You're gonna take L's. It's gonna happen. You're gonna lose from time to time. And with that being said, it's just important to maintain a disciplined approach so that you can easily accept the losses and move forward without being fully discouraged or disappointed. Because when we take those L's, it's important to bounce back from them. So just keep all these things in mind. This is going to be the key to trading effectively. You have to take the emotion out of it, and you have to be detached from the feeling of the trades turning this way or that way, whether it's positive or negative. And just adapt your trading strategy as you continue to grow and develop. All right, so before we dive into creating an account with a brokerage, I definitely want to make sure I go over the differences between a cash and margin account so that we have a clear distinction between the two. So with a cash account, you only use the money that you put in. So if you deposit $1,000, that's all you have to either risk losing or using to make profits. With a margin account, you're allowed to borrow money from the broker to trade. You can utilize leverage and short sale. But with a margin account, you are required to maintain a minimum equity level, and there's interest charged on borrowed funds. So keep that in mind. So let's take a closer look at the features of a cash account. First thing is that there is no borrowing with a cash account. So again, you only trade with the money you have deposited. Now with the settlements, it's usually a 2+2. So on that basis, this basically means you must wait for the funds to sell from the securities that you bought, which are stocks. They have to settle before using them again to buy new stocks. So essentially, you have to make sure you have enough money to continue trading with if that's your game plan. If not, you have to wait for those funds to fully settle before you can move forward. So I hope that makes sense. The cash account is what I would recommend for new traders, again, because you don't want to risk leveraging and you don't necessarily know what you're doing to have to pay back money. But let's go ahead and take a look in more detail at what this means so that you guys can get a full scope of everything. Okay, so again, the key takeaways with the margin account are that you can utilize leverage and short selling. Now, this allows for larger gains, but it also potentially runs the risk of larger losses than if you were to use a cash account. So you use the securities essentially in the account as collateral. I don't know how beneficial that would be to a new trader unless you just have the funds to be able to kind of like, utilize. But if you're not in that position, then stick to a cash account. Let me just kind of provide the last little bits of details of this so that you guys can see a clearer picture. Essentially, the overall scope is just understanding risks. Like, this is not going to be an account you choose if you don't have the funding for it. So again, the maintenance margin, that's going to be something you must maintain. If not, it will be a problem. There are interest charges as well for the margin account. So I think you guys pretty much get what I'm saying. My recommendation, again, use a cash account. You don't have to worry about as many different factors pretty much playing against you. So stick to the cash account if you're a new trader. If you're more advanced, then it doesn't matter either way for you. But that's the scope of everything for cash versus margin accounts. All right, y'all. So we're going to go ahead and assume that everyone has the knowledge they need in order to go ahead and open their brokerage account. So I'm choosing Charles Schwab, again, just because I'm familiar with the account. I understand the platform pretty well. So in order to go ahead and create your account, if you haven't already, now some traders already have their own investment account. And if you have a platform you're utilizing, you don't need to create multiple unless you just want to. But this is just for those who don't have an account already. Again, it's completely free to create one. So there's no need to like hesitate or wait unless you're waiting on funding or whatever it is. I don't know. But just understand the process. That way, when you do decide to open your account, you understand the step-by-step ways to do it. So all I did is I went to Google, I typed in Charles Schwab, and then I clicked on create an account as a first-time user. And with this, it's just basic information. They're going to ask you if you have your Schwab or TD Ameritrade ID, and that's just saying if you already have it. If you don't, then you just continue going. You're going to enter your date of birth, your phone number, social security number, and then you just keep moving forward in the process. Then you're going to confirm your identity. You guys can see that tab here. Then you're going to go ahead and create your credentials, and then they'll have some security preferences that you set up. And then from there, you essentially have your account. So there's not too much more that you would need to do. Of course, you would need to set up everything within Thinkorswim if that's the platform you're utilizing. So I'm going to go ahead and jump into that so that we get a full scope of understanding of that as well. But again, setting up the account is fairly simple. And with that, I also want to mention that it may take about a week for them to verify everything, and then you'll be able to actually log into your account. From there, you're able to download Thinkorswim. Of course, you can use the desktop version if you want to use your mobile device, whatever you need to do in order to make sure you're in the best position to trade as effectively as you need to be. Go ahead and utilize those strategies. From here, the remainder of the course will be me showing you guys how to set things up, how to place trades, and basically just becoming a pro at this, like mastering the art of it. It will take time. Nobody becomes a pro overnight. But if you use the techniques and strategies that work best for the way you analyze your trading psychology, you'll be onto it in no time. So let's just go ahead and continue on with the course. All right, so one resource I do want to highlight as something that can be pretty much like a fallback, or you may use it on a day-to-day basis, is going to be Yahoo Finance. This is going to be a platform that you can essentially look up stocks. You can look up if anything you want to compare. If you're looking to kind of make any type of technical analysis, they even offer those kind of features as well. You can look at the earnings, you can look at stock splits, IPOs, whatever you need to do. There's a ton of different ways that you can utilize this particular platform. Now, it is going to take some time to pretty much understand how it works, but I will say the interface is very user-friendly, so it won't take as much time to kind of just develop the flow of it. So take some time if you need, go to Yahoo Finance and just kind of play around with the website. If you need assistance with this, feel free to reach out. The community is set for you guys to pretty much ask questions. If you need help with anything, if anything is unclear, we're always going to be open for you guys to just, use us for the resources that we have. And then, of course, we'll always be here for you. So just continue to look at the leverages that you want to use and move forward with that. So yeah, keep in mind Yahoo Finance. Okay, so another resource that I definitely want to mention in this course is going to be entailing utilizing the brokerages and their websites. So it's important if you're a new investor, I would recommend utilizing the educational resources that are found on these brokerage sites, such as like Fidelity and Charles Schwab, whatever your preference is. The reason I would suggest utilizing these resources is because the information is coming from a reliable source. So you don't have to second guess if the information is accurate, because we know the internet is filled with a bunch of different opinions, and it can also go left or right with whether or not it's accurate information. But if you take it directly from like Fidelity, for example, which is what you see on the screen here, you pretty much can rely on that information being one, legitimate, and two, is going to be helpful. So that's just something to keep in mind. You can again choose to do that or not, but I would recommend it. So I'm on Fidelity's website, and you can see here I'm under where it says small investments could help your money grow. And then it's also giving us like a slider where you can look at today's investment and your monthly contribution, and it shows you what it would essentially turn into over a 30-year period. So we're going to go ahead and take a look. So if you invested, from what it's telling us here, $1 monthly, it's going to show us in obviously that 30-year period, you're going to make $1,220. Now, if you have this FDI insured savings account, you would be at $386. So let's just go ahead and slide it up. So we're going to go ahead and see what it would look like if we were to do just $100 a month. Now we're going to see it's at $121,997 versus the FDIC insured savings accounts is going to be at $38,594. We're going to keep sliding so you guys can see it over that 30-year period. It's going to incrementally move up. So let's go ahead and look at if you were to do $350 a month. Again, it's almost at $500,000. We're at $426,990 versus the $135. And that's going to essentially be what we would have if you were to contribute just $350 a month. And again, it's showing us over that 30-year period. So again, you can slide it up and continue to go. Let's just say someone was just going for $1,000 a month, right? They had that extra income to invest. We're going to go ahead and slide it all the way up to the $1,000. You'll see here you'll be at $1.2 million over the course of 30 years. Now, is this always going to be realistic for new investors and new traders? No, but it does give you a good indication and a good clue at how investing can help grow your money over time. It's not going to be perfect, and it's not going to be something that you always have to meet the mark at every single time, especially if you're just starting. But again, it's a reference point so you kind of can see the ins and outs of what your money can grow to become over the course of time. So I would say just utilize these types of resources. I'm going to show you guys a couple others as well. But this is a really helpful one, and it also kind of helps you paint the picture of what life could be like and what your money can essentially become as you continue to invest. Because savings accounts, again, nothing wrong with those, but investing does offer that higher return on investment just simply because of the way the market is set up. So again, just keep this in mind, something to utilize as a resource if you need it. Okay, so I also want to provide another resource because I think it's so important to understand how you can pretty much invest your money and see it grow in various different ways. So I've discussed dividends before, but I also want to show you guys a free resource, which is going to be this dividend calculator, and it can be found on dividendathlete.com, completely free. So it's just a resource that you can use to kind of calculate what you could expect for dividends. So you guys can see I have $1,000 as the starting principal at the top left. And then I have the annual dividend yield as 5%. That is pretty high, but you can adjust it. Let's say, for example, you want it to be at 3.2%, whatever you want it to be. If you want it to be at 4%, anything, you can adjust it to whatever you see fit. We're just going to go ahead and leave it set for the standard, just for example purposes for the video. And then you can have it as a taxable account. You can select yes or no for that. You can also change the dividend tax rate if you want it at 0%, whatever it may be. The expected annual dividend increase, it can be lowered to whatever you'd want. I'm going to leave it set at the standard default for 10. Some may say that's realistic. It's not. It just depends. Again, it's a free resource that you can just use. If it doesn't make sense for what you're looking at, again, just modify it for what works. And then, of course, the dividend payment frequency, you can have it for quarterly, monthly, or yearly. I'm going to leave it set for quarterly. You're going to look at your annual contribution, $10,000. Again, take that balance out if it doesn't make sense for what you're looking for. And then your expected annual share price appreciation. Change that. You can slide it left or right to go up or down based upon what you would want. Again, it's totally going to be what you see fit for what you're using for your plan. And then, of course, if you want to have for DRIP, you can select yes or no. And DRIP is just going to be you reinvesting the dividends that you've been paid out back into the market. So you can choose to do that, yes or no. And then we're going to look at the number of investment years. You can have it set for 20, 10, 5, whatever. I'm going to go ahead and scroll down so we can take a look at our portfolio balance and then the dividend income and the yield on cost. So we're looking at it from this perspective to understand exactly what we would see for payouts. So I'm going to scroll down so we can look at year one. So we're starting very modestly with that $1,000 principal investment. You're going to see the annual dividend would be $50.95 with a 5% yield, and then the yield on cost at that 5.09. After DRIP, it would then be $1,050.95. The principal increase is $100. That annual contribution, again, $10,000. And then we're looking at the cumulative dividends and then the total contribution. So that's just for year one. So again, go ahead and take a look at year two. If we were to continue on this same trend, right? This is going to be the balance it would be after year two, $11,150.95 for the principal. And you guys can see again the numbers. I won't read them all off because I know that can be kind of annoying to kind of just read what you guys can already see. So I'm just going to essentially show you when I scroll down. Let's look at 20 years. I'm going to scroll it all the way down. We're going to go ahead and take a look at the value at the 20-year mark. So you can see it's almost... Listen, like these numbers are, again, I know some people look at it and they're like, well, that's not really realistic. The numbers are actually, like, if we were to adjust this, I know some people may say these numbers up here as far as like expected annual dividend increase, that's not realistic, but we can slide it down and you guys can see it at, more realistic numbers, right? But it's something you can totally play around with to see what would fit. But I'm showing you guys the real numbers. Again, use it for what it's worth. And then just understand here. So even if we were to slide it down and be more modest, you guys can see that's still nearly, that's $500,000 right there, right? You guys can see at the 20-year mark for $485,000. So that's a decent amount for just dividends in itself. Now, granted, that's over a 20-year period, but also understand that we had it set for a modest $1,000 for our principal, starting point, and where annual contribution is at 10. And if you're options trading and you're profitable, you can contribute a whole lot more than that. So it just depends on what you have. So I just wanted to share this resource. Utilize it if you see fit. If not, it could be just something you reference from time to time just to kind of get a calculation on what you would need for, long-term investing. So just keep this in mind. Okay, so now we're at the point in this course where you have knowledge of the basics, you've selected your brokerage account and set up your account, and you're able to log in. So that's perfect. Now that you're all set, we'll discuss how to place trades. Now remember, you don't have to trade options. You can simply buy and hold shares of stocks or ETFs that you want to keep long term. So I'll show you how to place a standard trade and an options trade. Now you'll need to customize the interface to fit exactly what you want, and that can take some time. So on the screen, I have a sample watch list that I use just for example purposes. And again, I'm utilizing Thinkorswim, and you can have your dashboard set up in a similar capacity as well, totally your choice. So let's break things down for simplicity. At the top left, you see the symbol, and this relates to the stock's ticker. And a ticker symbol is just the abbreviation or acronym for the stock. And this can simply be, for example, SPX is going to be the S&P 500, TSLA is going to be Tesla, and then AAPL is going to be Apple, and so on and so forth. And on the right side of that, we see the numbers associated with each stock's variable. These are going to be the things we take a look at. So let's go ahead and jump into a few examples. So I'm going to go ahead and use QQQ. I'm going to select it, and then I'm going to click on Show QQQ Details. All right, so the first thing we see at the very top, again, is the ticker symbol. There is an arrow associated with it. I'm going to hit the drop down. This will show us things that we already have discussed, such as market cap, volume. You guys understand these things, right? So you can scroll over and it'll tell you more details in terms of 52-week low. You also see the PE ratio if it popped up. All these good things are going to be necessary. And you can see here, you can customize it if you wanted to choose to do that. So if you did want to customize it, all you would simply have to do is just scroll over to it. You'll see the customize, hit the gear icon, and then of course you'll see on the left side they have the available points, and under it you see the categories, and you can pretty much select like the indicators or anything you would want. So let's say for example you wanted to search up maybe the MACD. You can go ahead and put that in, hit the green plus, and then of course you'll see it added. I'm going to hit cancel or whatever. And then on the right side, you see the visible points reset to default. You can change it to whatever. We can also move these up or down depending on where you would want them. And then at the very top, underneath Customize, you see where it says Stocks ETFs, there's a drop down. So you can go ahead and select futures if you wanted to look at that, options, the indices, anything you select is pretty much going to be customizable. And then once you have it set for what you would want, all you would have to simply do is just click out of it and then it's on your chart. So that's a way to customize what you would see as far as Thinkorswim, making sure it looks the way you would want. And now you can see under Customize, you see MACD is there at 7.84. So again, just completely take your time, work through it in terms of understanding how the functions of all these things work. It'll take some time to do that as well, but again, it's worth it. So just kind of look through it, make it your own. So again, the first thing to always note is what is the current share price of the stock or ETF. So in this case, QQQ is trading for 479.11. So that's the important thing we need to know. Now, if you just wanted to place an order just to buy QQQ on itself, you wouldn't need to go under options, okay? You would just simply click on trade and then you would place the order. So let me show you how that works. I'm gonna go trade and then QQQ is here. Now you see it says, again, you're just standard buying one share. You can choose to buy 2 shares, 3 shares, whatever you would want in terms of your buying power. And then you would go ahead and click on review. Let's say, for example, you're just wanting to place a standard trade. That would be your order confirmation to say, hey, you're just buying 1 share of QQQ at the current price. You hit send, and then you would go ahead and have the order sent. Now you would be a shareholder of QQQ. Okay, so I hope that makes sense. So before we hop into how to place an actual options trade, I definitely want to make sure we touch on how to chart effectively, because that's so very imperative when you're first learning how to trade options. And then if you're just investing in general, it's important to understand what the chart is doing. So what I'm going to go ahead and do is from a high level, just kind of explain how you would go about looking for support and resistance, supply and demand zones. These are going to be key areas within anyone's trading strategy that you would have to understand in order to effectively make sure that you're profitable. So you guys can see here, I've charted for 2 levels so far. And you can see the reason being is going to be because these touch points, these price levels indicate that the stock is either going to respect or reject that level. Now, again, it's going to be something you learn over time, so don't feel pressure that you have to know it exact. And you can always edit. For example, you see here, if I didn't have it exactly at that point that I wanted to, you can have it edited. Luckily, my precision was just really good with that placement, so it was exactly at the low. So that's 164.93 for that level. Now I'm going to, of course, chart for the high, which is going to be that 503. So I'm clicking on price level, that money sign, and then you're just going to go ahead and touch those points, kind of line it up as best you can, and then go ahead and make sure that you have all the key levels you would need. Now, I don't want to go too deep into it because I don't want to leave anyone confused, but you can see different zones. And I'm going to show you in just a second why these zones that I've charted for are important. Now, of course, there's tons more that you can see on the chart, but I wanted to kind of keep it simplistic so that, again, no one is leaving here with like confused looks on their face. Like, this doesn't make sense. Why are you charting for these levels? Again, it's going to be touch points that you would see. It's going to show a pattern over the course of history. And again, I have it on the 5-year weekly. I want to make sure it's a full scope that you can see, right? Because those key levels are going to be necessary. So I just charted for that 315. That's extremely important. I'm going to show you why in just a second. Okay, so I'm zooming in so that everybody can get a clear clue as to what I'm doing. Okay, so now I'm going to go ahead and show you using this indication right here, this oval. You guys can see in 2021, that price level again at 315. I'm highlighting that to show you where the stock pulled back to. And then I'm going to also show you again here in 2022. You guys can see kind of early on in 2022, same level, price level pulled back. And you guys can see the trend in that, right? Now, that's going to be a level of support. Remember, the support level is important to know. But if I move forward, you'll see that support can also turn into resistance. So right here in 2023, you'll be able to see it in just a second. I'm going to pull that up. You're going to see that support has now turned into what? Resistance. See that there? So that 315 level was once previously a support level. Now you can see it has become a level of resistance, but you can see in 2023, it broke that level. Okay, so this is just simply how you would go about understanding the basics. We'll just continue to move forward. Okay, so now I'm going to go ahead and drop it down to the 4 hour within the time frame on the chart. Why? Because I want to show you guys different variations of times. That way you can see exactly how the stock is performing. So it's important to know these things as well, because you want to look at the full scope. You never want to limit yourself. So you can see here, I'm charting for this price level right here at the 473. We're going to go ahead and touch that as a point as well. And we're also going to go ahead and take a look at a few other levels. That way you guys can see how this is going to perform, again, as you get smaller and smaller on the time frame. So I'm going to go ahead and have that touch point for 443 as well, that price level. We're just going to continue to look for clues and indications of where you see clear levels of support and resistance. You can also chart for gap fills, again, and if you see the pattern, which again, you'll see multiple times when you're charting. There's so many different variations and ways to do this. And I'm going to go ahead and drop it down to the 1 hour chart as well. And now you're seeing more so of a clearer scope of things, because you can see more blue lines that you'll see now, right? Because it's a smaller and smaller time frame. And you'll begin to see more as you continue to drop down the levels. Now, with charting, I will say it does take time to fully understand why you select certain levels. And it is a bit subjective, I will admit. Some people decide to chart for just simplicity purposes. Other people chart and they're very, very specific. And again, it can be effective either way. It's really just, subjective in how you choose to do it. Now, within this, I do want to make sure that everyone understands that when you're charting for specific levels that you feel are going to be like touch points for like confluence and divergence, you can't ignore anything you see in terms of volume. So volume bars you'll see at the bottom, those also are going to be so important. So now I've dropped the time frame down to 30 minutes. We're going to, again, keep doing the same thing. You're looking for those key levels of support and resistance. Now I'm down to the 15-minute. And I'm going to go ahead and zoom it out so you guys can get full scope. Now within this, it's a continuation of what I've been doing. So again, I'll continue to drop it down 10 minutes. Now we're looking at that time frame. Because why? I don't want it to be super, super repetitive, because I know it can be kind of, daunting to just look at the same patterns over and over. But again, y'all know I love to trade off the 2 minutes, so I had to show y'all that for sure. Going to show you the 2 minute time frame. Now we're going to take a look at a few things within the 2 minute, because again, it's always my focal point. It's pretty much how I like to trade off the 2 minute time frame, just because I feel like it gives me the most clear picture of what I'm looking for within the plan that I would set for the day. And then it also gives you those obvious pullbacks. I just prefer the 2 minute time frame for trading. So yeah, I'm showing you guys QQQ. This is obviously a different day because you can see the numbers are different. So I'm going to go ahead and continue to just chart for price levels, those highs, those lows, and you guys can see consistency within it. Now, again, as you continue to develop as a trader, you'll see various different ways in which you can chart for price levels. You can have some of them kind of coinciding with like trend lines, and I'll show y'all a few trend lines. This was actually a perfect setup to show y'all trend lines as well, and I'll do that in a second. But I'm charting for the high, charting for the low, showing you guys just different ways you can go about understanding these zones. And it really just kind of is self-explanatory. You don't have to overcomplicate it. I will say that when you're first starting, it's easy to kind of make it a thing where you're just kind of overcomplicating it. But keep it simplistic. Just look, again, highs and lows. If you know nothing else, just look for the highs, look for the lows, and then understand why you have selected those areas and look for the clues and patterns. So if you see a pullback and then you see the stock drops down, or maybe there's a gap fill, if you see a level of divergence where it's not doing what you thought it would do and it's kind of diverting away, that's another thing. So now you can see my first trend line that I'm charting for, and it's going to be a duplicate trend line because you're going to see the stock does the same thing. So we're looking at it again. So we see that it's going to be those touch points. Now this would have been a perfect setup. I didn't trade on QQQ at this particular time frame at this day, but again, look at the setup. It literally is history repeating itself. You guys can see that here. So you can see at 10:30 pretty much on this particular trading day up until about 10:45. That would have been a perfect setup because history, again, it repeated itself and did the same thing around 12:30 up until about 1:30. So you see the pullbacks, it touches on that trend line, and then it rises up, and then it pulls back, touches on that trend line, rises up again. So you can do the trend lines in terms of whatever you want for like bullish, bearish flags, whatever you're trying to indicate that you see on the chart. It could be a head and shoulders, it could be a double top, it could be anything that you see that's going to, stand out. And you don't have to restrict yourself within this. Again, kind of mark the chart up. If it doesn't make sense to anyone else, as long as it makes sense to you, that's really all that matters, okay? So when I chart, again, I'm kind of being very modest, and I'm also showing y'all the pattern within this, because this trend line literally carried all the way up for like a matter of 3 hours. So it's important to know that oftentimes, again, once history repeats itself with these charts, you guys don't have to do a whole bunch of guesswork. The stock is really doing it for you. Well, ETF in this case, because yeah, QQQ is an ETF. But you can understand what I'm pretty much going for when I'm showing you guys this. If you would have traded at this particular time period, super easy to be profitable, because you, again, it's respecting that level within that trend line. It's doing pullbacks, and then it's a drawback, and then of course it's rising up. So once the stock rises up, it kind of consolidates a bit, and then it pulls up even higher, creating that higher high, and then again doing the same thing. So again, it's just history repeating itself, nothing really crazy. You can just see those various zones, and that's pretty much what you would need for this. Again, don't overcomplicate it, you guys. I know it can be tough, but try to keep it very simplistic and just don't overthink it. Okay, so now I want to go ahead and transition into breaking down a few things in regards to option contracts. I want to primarily focus on the price of the option premiums as it relates to the DTE. I have made previous videos explaining the DTE and how it affects the options price and how the premiums are arranged. So I'm going to go ahead and start with the calls, and we're going to go ahead and take a look at the 483 strike price. You can see that particular bid is going for $166. The ask is going to be $168. Okay, so keep that in mind. We see QQQ is trading for $482, but the contract for a $1 incremental move up is $166. Let's look at the 481 strike price if we're looking at puts. This contract is going for $169. The ask would be $172. Okay, so keep that in mind. So now we're going to go ahead and transition out. We see that's the DTE for 1 day out. Let's go ahead and scroll down a few weeks, and we're going to take a look in August. We're going to look at August 30th, and that's going to be 39 days out of DTE. We're going to look at the same strike price of 483. You can see the bid is actually going for $1,290 for that same strike price, right? Keeping that in mind. And then if we look at the puts, I'm going to scroll up a little bit. Look at the bid price for that same 481 strike. It's going to be $1,017 for this options contract. So you can see the differences here and how this affects everything you would need for your contract. Starkly different for the same price, but the DTE is changing everything that you would have, right? As far as the pricing and what you would pay up front. Now, there's strategies to this, and we'll talk about that, but it's important to know this. I just wanted you to keep this in mind. Okay, so I also want to take some time to kind of talk about a few of the things that people use for indicators, because I know sometimes if you're a new trader, it can be kind of difficult when you see people's chart marked up and you see different levels and you see all these different lines and you see like these zigzag patterns. It can be kind of confusing if you don't know what you're looking for and you're like, well, why did they choose these things? Those are going to usually be indicators you see on people's charts. So I'm going to go ahead and show you a few of the studies, and you guys can choose which works best for you after you've developed into a more experienced trader. You'll decide what patterns and what indicators are going to work. I always suggest that you don't use indicators as your first level of confirmation. You should use indicators simply as the second or third level of saying, okay, yeah, what I see on the chart is making sense. What I see on the chart is going to be fully what I know is going to be projected for the stock or the ETF. But the projection is going to be backed up by the confirmation of the indicator, if that makes sense. Okay, so I just want to show y'all a few of them. So we're going to go ahead and take a look at crossovers. I'm going to go ahead and click this. This is going to show you everything from the ADX to the Bollinger Bands to the MACD to the momentum to the stochastic. These can all be ones that you use. If you become comfortable, you'll usually decide to like one more than the other, or you may have a few that you like. So these are just going to be a few for crossovers. I'm going to scroll down. I know some of the more popular ones obviously are going to be under the momentum, and that's going to be everything from the MACD, momentum itself, the RSI, I always use that, stochastic. It's also going to be TTM squeezes under this category, and then of course those volume weighted MACDs, and then of course the true range indicator, the TRI, is going to be good as well. So I'm going to go back, and then we can also take a look at the volatility studies. This is going to show us everything from implied volatility to the TTM squeeze. Once again, you're going to see that percent change, good always to have those indicators in mind as well when you're charting. We're going to go ahead and take a look at a few moving averages. Of course, the SMA, EMAs, those are all going to be under these categories. You guys can see them here. And then, of course, is there any other ones that are really good to point out? I like to use, yeah, most of these are good. Yeah, some of these I haven't even used before. There are so many indicators that you can, utilize. Some of my favorites, you guys have seen my videos. I love the EMAs. I love Fibonacci retracements. All those good things are going to be good. So I'm going to hit the back button. So yeah, I'll say just play around with it. And if anyone's wondering how I got to it, just click on the beaker icon. I'm on the Thinkorswim mobile, so you can choose it on the desktop. Same thing, you'll see the same icon. And just look through the studies, look through the categories, decide what you feel is going to work best after you've kind of tested it out. And if you do like certain indicators over others, you'll be able to kind of decide if you want to stick to it as you continue to develop within, becoming a more advanced trader. All right, so let's look at options. That way you guys can see how this works a little bit differently from just buying standard shares of a company. Now we're going to go ahead and take a look under the options tab if you don't already have it pulled up. We're going to look at the strike prices. And if you're unaware of what a strike price is, that's essentially the mark that you're anticipating the stock to either move in that direction of. So since QQQ is currently at 479, we would then look at strike prices that would either be in the money is what I would recommend. But before we do that, let's break down what we see under the calls and the puts. So a call is going to be essentially you anticipating the stock to rise. Puts means you anticipate the stock to fall. So those are the two key factors we need. I'm going to go ahead and collapse this sample watch list. That way we get full scope. Now we see here at the bottom left, you see it says 1 July 24, and then it has in parentheses 1. The parentheses is always going to tell you the number of days to expiration, known as the DTE. So in this case, the DTE is 1. Why? Because we'll see that tomorrow obviously is July 1st. Well, at the time of me filming this video, tomorrow will be July 1st. And that lets us know that that is when the contracts will expire. So I'm going to go ahead and show you on the right side, you see that there's a 17.22%. And then they have in parentheses the plus or minus 3.352. This is going to tell you the implied volatility, and we'll discuss that more in detail. I also have an ebook where I talk all about technical indicators and I break down different factors and variations of this. So let me go ahead and hit the drop down for July 1st, which is tomorrow. Okay, you guys can see here, now it shows us different variations. Now the last video I made, I talked about the Greeks, so that's why you see them pulled up here. I won't go over all the details of the Greeks because I'm going to leave a link to that in this course so you guys can watch all about learning how the option Greeks work. So what I'm going to do now is scroll down a little bit. You guys will see here, I'm going to look at the 480 strike price because we're going to focus on calls to start. So we see the bid is going for 1.42. The ask is going to be 1.47. So if I anticipate the stock to move up $1 to 480, that would be the strike price that I would go ahead and look at. With that being said, in order to place a trade for that, let's say I'm confident that it'll do that. I did all my technical analysis. I understand fundamentals, and I'm pretty confident the stock will move up at least $1. What you would do is choose to either buy the bid or the ask. Personally, I always like to buy the bid because it's cheaper. So you're going to go ahead and touch on the 1.42, which means you would pay $142 for this one contract. So when you touch on it, it'll pull up. Then you're going to see where it says tap option quantity to edit. Go ahead and hit next. And from here, it's going to show you the order editor. So let's go ahead and break this down in more detail as well, so you have full scope of how to order essentially what you would want for your stock. All right, so the very first thing I want everyone to keep in mind is that you should already have a stop loss, stop limit, or trail stop predetermined before you enter into any trade, okay? So never enter into a trade without knowing how you're going to exit. Your exit strategy is imperative. So with that being said, we're going to say, for example purposes, let's say we pay $142 for this one contract. Let's say I only want to lose, let's say $10 if it doesn't go my direction and it actually, drops and it doesn't rise to 480. Let's say the stock is going to drop, right? I only want to risk losing $10. So we're going to keep that in mind. First thing I'm going to do is go ahead and click on the buy because we have to buy it first. Now above buy, you guys see where it says add option leg. If you click on this, it'll show you how to configure a spread. I won't cover that in this particular course because it's a little more advanced, and I'll have that for the premium stock trading course. just because, again, that can be a little more complex for beginners. So I'm going to hit cancel. But in order to place an order, I would recommend doing an OCO or a first trigger OCO. So now in order to do this, you guys can see, of course, I have it. They put it at 147. I'm going to go ahead and drop it back down to the 142. That way we can buy the bid. You're going to click on more. And then you're going to go ahead and click on create advanced order. So at the top, you see it. We're going to go ahead and review it before we even move forward. You see it's set today. You can also choose to have it good till cancel. It's your choice on that. I'm going to go ahead and hit the back button, that group. Now on the left side, you guys see where it says add order and there's a plus symbol. This is going to be our take profit side. And then on the right side, it'll be our stop loss, stop limit, trail stop, whatever you choose. I'm going to go ahead and click the plus to add an order. And we're going to go ahead and click on it again. So we're going to go ahead and sell. So you see where it says the limit is at 2.42. We're going to keep it realistic, and I'm just going to use $10 up or down just for example purposes. So if we paid $142 for this contract and it's a play for calls, we're going to go ahead and just say we want to just make a $10 profit. Again, you want to make way more than that, but for example purposes. So if you want to make a $10 profit, you're anticipating the stock option price to be at 152, right? So that would be your take profit target. So you can go ahead and type that in. I'm going to go ahead and put in 1.52, and that will tell us we're just looking to sell this if we get a $10 profit because we paid $142. Now the stock has then reached $152 of value for the option contract. So that's where you would want to sell at. So then go ahead and hit done, and that'll be, again, your take profit. Now on the other side, you're also going to need to set that stop. Click on add an order, and then you're going to click on the sell for it. Now, again, we're anticipating it moving in our direction, but if it doesn't, we want to make sure we hit limit and go to stop. You may do a stop limit, again, trail stop, whatever you choose. Let's say, for example, the contract drops, and again, you only want to lose $10. So with that being the case, you're going to go ahead and take that off and put it at 1.32 because that would be $132 that the option contract is now worth. Again, essentially we paid $142, so $10 less would be $132. You're going to go ahead and hit done for that. And now you will see you can hit review, and it'll show you exactly what you're looking to do. Okay, so you have the order, pretty much confirmation is going to pull up. It's telling us you want to buy one call. Again, we're just looking at one contract at $142, which is the limit. And you're going to sell if the stock option contract reaches $152. You're going to take your profits, that $10 incremental move. But if it doesn't do that, you're going to go ahead and have that stop set at $132 because you're done. You don't want to lose any more money. From here, all you would do is click send, and that would complete how you would place an order for this particular option contract. So I really hope this makes sense. If it doesn't, again, feel free to reach out. You're a part of the community now. I can walk you through this process multiple times over. So just let me know. And I've also made a video explaining like the trail stop and stop loss. So I'll leave that link so you guys can see that as well. So let me know if you have any questions on this. I hope it makes sense. All right, y'all, that'll just about do it. Thank you so much for taking the time to complete this course. I do hope that you found value in the content. We've covered quite a few topics, and if you're a beginner, it will take time to master your own skills and techniques, so just be patient. If you're interested in learning more, or if you want advanced knowledge on my specific trading strategies, feel free to check out the premium stock trading course. You're also more than welcome to join our Discord community. I look forward to interacting with you all, and here's to your success.